Hello, everyone, and welcome. In this session, we are going to dive into one of the most foundational and powerful topics in managerial accounting: cost classification. Think of this not as a set of rigid rules, but as learning the very language of business. Understanding how to classify costs is the key that unlocks your ability to make smarter, more profitable decisions, whether you're in accounting, finance, marketing, or running your own company. To see what I mean, let's start with a story. This is Cos Marte. He's the founder of a successful fitness company called ConBody. After turning his life around, he built a business dedicated to helping others. But passion alone doesn't guarantee success. Every day, Cos faces critical questions: which of his fitness classes are actually making money and which are losing money? Should he invest in adding more online sessions or focus on his physical locations? The answers aren't just in his gut, they are in the numbers. And to get those answers, he first needs to understand and classify his costs. This is exactly what we're going to learn how to do today. So, why do we need so many different ways to classify costs? Well, as the slide says, you wouldn't use a screwdriver to hammer a nail. The simple answer is that we classify costs for different purposes. If we need to determine a price for a product, we need to assign all the costs to make that product. For financial reporting, that is creating the balance sheet and income statement for external stakeholders, we have to separate our manufacturing costs from our non-manufacturing costs. If we are trying to create a budget for next year, we need to predict how costs will behave as our sales go up or down. And finally, when we have a big decision to make, like whether to launch a new product line, we have to identify which costs are relevant to that decision and which can be ignored. Each purpose requires a different lens, a different way of looking at costs. Let's start with the most fundamental classification: the difference between direct and indirect costs. A direct cost is a cost that can be easily and conveniently traced to a specific cost object. And a cost object is just anything we want to know the cost of, whether it's a product, a department, or a customer. For example, if Adidas is trying to find the cost of one of its shoe models, the cost of the leather used for that specific shoe is a direct cost. Now, I want you to pause the video for a moment and think of another direct cost for this shoe. If you thought of something like the wages of the assembly line worker who physically put that shoe together, you're exactly right. On the other hand, an indirect cost is a cost that cannot be easily traced to our specific cost object. These are often called common costs because they support multiple cost objects. For instance, the salary of the Adidas factory manager is an indirect cost of a single shoe. Why? Because that manager oversees the production of thousands of shoes across many different models. It would be impractical, if not impossible, to trace a tiny fraction of their salary to one specific shoe. So the key takeaway here is critical. A cost isn't inherently direct or indirect. It all depends on what you define as the cost object. Next, let's look at a classification that is absolutely essential for financial reporting: product versus period costs. Product costs, also known as inventorable costs, include all costs necessary to make a product. This includes direct materials, direct labor, and manufacturing overhead. The key concept here is that these costs attach to the product itself. They follow the product on a journey through the accounting system, from raw materials inventory to work in process inventory to finished goods inventory. They only become an expense on the income statement, called cost of goods sold, when the product is finally sold. Period costs are, quite simply, everything else. These are costs that are not part of the manufacturing process, like the salaries of the marketing team or the administrative staff. Their journey is much simpler. They are recorded as an expense on the income statement in the period that they occur. This distinction in timing is a cornerstone of accrual accounting for manufacturers. Now let's switch gears from a financial reporting view to a planning and decision-making view. Here, we care about how costs behave. A variable cost is a cost whose total amount changes in direct proportion to changes in activity. The classic example is the per-person meal cost for a tour company like Nooksack Expeditions. If each meal costs $30, the total meal cost is $30 for one guest, $300 for 10 guests, and $3,000 for 100 guests. The total cost varies, but the per unit cost, the $30 per guest, remains constant. This activity that drives the cost, like the number of guests or machine hours worked, is called activity base or cost driver. Conversely, a fixed cost is a cost whose total amount remains constant, regardless of the level of activity within a relevant range. For Nooksack, their $500 monthly rent for their equipment building is a fixed cost. They pay $500 whether they serve 10 guests or 1,000 guests. But notice what happens to the per unit cost. If they have more guests, the average rent cost per guest goes down. This leads to a word of caution. Be very careful about using average fixed costs per unit for decision making. They can be very misleading because they change with activity. This brings us to perhaps the most important set of classifications for you as a future manager. When you're making a decision, not all costs matter. The only costs that matter are relevant costs. A relevant cost is a future cost that differs between your alternatives. If a cost is the same for both options, you can ignore it. Next is the opportunity cost. This is the potential benefit you give up when you choose one alternative over another. It's a powerful but often invisible cost because it's not recorded in the accounting books. For example, if you decide to take a week off for spring break, the opportunity cost might be the $200 in wages you could have earned from your part-time job. Finally, and most importantly, we have the sunk cost. A sunk cost is a cost that has already been incurred and cannot be changed by any decision you make now or in the future. Because you can't change it, it is always irrelevant. You must ignore sunk costs. A classic trap is a manager who continues to pour money into a failing project because they've already spent so much on it. That original spending, like the $50,000 paid for a now obsolete machine, is gone. Making decisions to recover a sunk cost is a common and costly mistake. Let's put this all together with a modern, real-world example. In response to growing mental health needs, CVS began offering counseling services with licensed social workers in some of its stores. Let's analyze the costs of this new service using our new toolkit. A direct cost to a specific store's counseling service would be the salary of the social worker at that particular location. An indirect cost would be the cost of the corporate administrative staff that oversees the entire mental health program across all locations. A variable cost would be the cost of supplies, like workbooks, used for each counseling session. A fixed cost would be the portion of the store's monthly rent that is allocated to the space used for the counseling office. And an opportunity cost? That's the revenue CVS gave up by using that retail space for counseling instead of stocking it with high-margin products. You can see how all these classifications work together to give a full picture of the business decision. So, let's summarize the key takeaways from our session today. First, the most important answer in managerial accounting is often, it depends. How you classify a cost depends entirely on the purpose of your analysis. Remember our key distinctions. Direct versus indirect asks, can we easily trace the cost to our cost object? Product versus period asks, is this cost part of the manufacturing process? This determines its flow through the financial statements. Variable versus fixed asks, how does the cost behave when activity changes? This is crucial for planning and budgeting. And relevant versus sunk asks, does this cost impact a future decision? This is the key to making smart choices. Mastering these concepts is the first step toward using financial data to drive strategy.